Every few weeks, somewhere in the world, a group of people walk into a quiet meeting room and decide the price of money. No crowds, no elections, no headlines in real time. Just a table, some charts, a vote. And by the time they leave that room, mortgages will become more expensive. Businesses will delay hiring. Stock markets might crash. Entire governments will feel the pressure. We're told this is how the modern economy works. Central banks control interest rates. Interest rates control borrowing. Borrowing controls growth. Simple. Except there's a problem with that story. Because if you follow the money carefully enough, something strange appears. Central banks may announce the price of money, but they don't completely control it. And the deeper you go into the system, the more you realize that interest rates are not just a policy decision. They're the result of a much larger power struggle inside the global financial system.
A struggle between governments, banks, investors, and debt itself. To understand this, we have to start with a basic question. What is the price of money anyway? When economists talk about interest rates, they're really talking about the cost of borrowing. If you borrow $100 today and pay back $105 next year, the price of borrowing that money was 5%. That 5% becomes the heartbeat of the entire economy. It decides mortgage payments, car loans, credit cards, corporate expansion, government debt. Change that number slightly and trillions of dollars start moving differently. Lower the rate and borrowing becomes cheap. Raise it and borrowing becomes painful. So in theory, the central bank, like the Federal Reserve in the United States, controls this number. They meet, they vote, and they set a benchmark rate. That benchmark rate is supposed to ripple outward through the entire financial system. Banks adjust their lending. Markets adjust their expectations.
Consumers adjust their spending. But here's where the story becomes more complicated, because the central bank doesn't actually set most interest rates in the real world. Markets do. When a government issues bonds, investors decide what yield they demand. When banks lend to each other overnight, the market sets the rate. When investors buy corporate debt, they price the risk themselves. The central bank influences these markets, but it doesn't command them. And sometimes, markets simply refuse to cooperate. This has happened before. In the late 1970s, inflation in the United States was running out of control. Prices were rising more than 13% a year. The central bank had a new leader, Paul Volcker. He made a brutal decision. Interest rates would rise dramatically. By 1981, the federal funds rate climbed above 19%. Mortgages shot past 18%. Businesses collapsed, unemployment surged, but inflation finally broke. Volcker proved something important.
A central bank can push rates higher if it is willing to tolerate pain, but pushing them lower is a different story, because lower rates require one thing above all else: trust. When governments borrow money, investors need to believe they'll get paid back. If that belief weakens, interest rates rise automatically, no vote required. This is why countries with unstable finances face brutal borrowing costs. Argentina, Turkey, Greece during the Euro crisis. Investors demand higher yields because the risk feels higher, and suddenly the central bank's control starts to look limited. The market is now in charge. But there's an even deeper force shaping the price of money: debt itself. Right now, the world is carrying roughly $300 trillion of total debt. Governments, corporations, households, all of it stacked together. That mountain of debt quietly changes what interest rates can realistically be.
Because when debt levels get very high, even small increases in rates become dangerous. A government that owes trillions cannot easily handle borrowing costs doubling. A corporation loaded with loans cannot survive if refinancing becomes expensive. A housing market built on cheap mortgages collapses when rates spike. The system becomes fragile, and fragility limits how far interest rates can rise. In other words, the more debt the world accumulates, the less freedom central banks actually have. This is the irony at the heart of modern finance. Central banks appear powerful. They announce the price of money. Markets react instantly. But behind that power sits a massive constraint: the debt already in the system. Raise rates too much and the system cracks. Lower them too much and inflation explodes. So the real job of a central bank isn't simply controlling money. It's managing the tension between debt and stability. And that tension has been building for decades.
After the financial crisis in 2008, interest rates around the world fell to historic lows. In some countries, they even went negative. Investors were literally paying governments to hold their money. At the time, this seemed absurd, but it revealed something important. There was so much debt and so much fear of economic collapse that keeping money cheap became the safest option. Cheap money kept governments solvent, it kept corporations borrowing, it kept stock markets rising, and it kept the system running for a while. Then inflation returned. Suddenly, central banks faced a dilemma: raise rates to fight inflation or keep them low to protect the debt-heavy system. The last few years have shown how difficult that balance is. When rates rise quickly, banks break, housing markets freeze, governments start paying massive interest bills. But when rates stay low, the cost of living spirals upward. Every choice creates a different kind of instability.
Which brings us back to the original question: who really controls the price of money? Central banks influence it, financial markets pressure it, governments depend on it, and the giant mountain of global debt quietly limits all of them. In reality, interest rates are less like a dial someone turns and more like a negotiation between powerful forces trying to keep the system from falling apart. And that raises a strange possibility. If the world continues adding more debt, and if economies become increasingly dependent on cheap borrowing, then the real price of money may become harder and harder to raise. Not because central banks refuse to raise it, but because the system itself can't survive if they do. Which leads to an uncomfortable thought. If the price of money can't rise without breaking the system, who is really in control anymore?